Hi, thanks very much for your interest in the property solution. Before we get into the property investment, I just want to give you a very brief introduction about Carrick and myself and how we help our clients. So we are an independent financial advisory firm, head office in Cape Town, and we focus on our clients through the various stages of their financial planning. We help them grow their wealth and investments. Then they'll get to a stage when they need to protect their investments and wealth solutions. And then obviously succession planning is a very important factor of wealth planning, which will guide our clients through that process as well. So we recently won a best practice firm in advisory firm in South Africa from the International Advisor Award, which we're very proud of. It was about a couple of weeks back. So just a little bit about Carrick. So we've got 7 offices in 5 countries, and we will be opening our office in the UK in early 2020. We've got regulated licenses to operate in the US, UK, obviously South Africa and Mauritius, and throughout Africa, and actually pretty much give advice throughout the world. We've managed around $500 million at the moment under management, but what we're most proud of is that in our short history, we won several awards, and most recently we won the top wealth manager for wealthy executives at the 2020 Intellidex Awards earlier this year. And that was followed on by a couple of weeks ago at the International Advisory Award, the best advisory firm in South Africa, as well as for excellence in investment planning and business practice. A little bit about myself. I'm actually a chartered accountant by profession. I've got over 25 years in South Africa and offshore, where I lived in Australia for a couple of years and now qualified as a chartered accountant and completed a Master of Taxation. In Australia, I worked in the private wealth management space as well as the tax advisory space. I came back to South Africa a number of years ago, where I worked at Old Mutual in several positions, landing up managing around 40 billion rands worth of pension funds in a fund of funds at Old Mutual. And then I moved into the property industry, where you can see my affinity to property is. I was the CFO for a 5 billion rand private property company where we owned over 25 shopping centers throughout South Africa. And then I moved to become the head of finance for JC listed property fund. I moved into the investment space back similar to Old Mutual and back similar to what I was doing in Australia, where I was headed a CFO and COO for an offshore ETF funds where we were listed and had Regulation 28 funds. And in the last 5 years, I've been with Carrick, helping my clients managing their wealth both locally and internationally. So Carrick, very briefly, our offering is we are independent financial planners. We help our clients with, as I said, the various stages of their life, both in South Africa, and our key expertise is on offshore wealth management. We always make sure that things are very tax efficient. My background is very strong in tax, and that's a very important factor of wealth planning, is making sure it's very tax efficient. Obviously, you want to protect your assets, so we look at capital protection is actually also very important. Foreign exchange, we can arrange for you excellent rates, better than you'll get at most of your banks. As I said, our key specialty is South African offshore retirement planning in the pension space, trust planning. We can also help you with the international corporate structures. We've helped several companies set up offshore companies and make sure that it's working properly. We also do cover risk cover, so life insurance, disability, group life, business assurance, buy and sell agreements, key man policies, which is very important in today's business environment. Leading on to properties, a key part of anyone's portfolio is property, both in South Africa and offshore, and that's where we're leading on to the Section 12Js. And we also have a Carrick Consult, which is a legal department which helps with wills and estate planning. We can also help you with guiding you on how to exit your existing business, which is also quite an important part of your career and wealth planning. So we can help you with all these different functions. So just getting on to the Section 12, we've looked at Flyt with a property, and they also with Anuva. Anuva is the actual Section 12J provider, which we'll get onto later. I've actually personally been to all these properties, and I like all of them, so I would highly recommend. So just to summarize what Section 12J is, you get an immediate income tax capital gains tax deduction of up to 45% in this current tax year, so year ending February 2021, and your total investment will only be 5% cash down. I just want to reiterate that this cannot be construed to be advice, but just one of the offerings of many solutions that we do offer. This is just one I'm trying to highlight to some of my clients and colleagues out there, which is, I think, a very good opportunity to take account of, but you need to speak to me or your financial advisor to make sure this is the appropriate advice for yourself. So just to summarize what Section 12J is, if you put £1 million investment in, you'll get a Section 12J relief straight away. So you get up to 45% straight away back in the 2021 for the 2021 tax year. You'll put down a 5% deposit, and then you'll either finance the balance through your own mortgage, which we'll guide you through, or Flyt have got the in-house mortgage department, which they will actually finance it in-house, or of course you've got the cash offering as well. This applies to both individuals and trusts, and corporates can also take cognizance of this opportunity. So now we'll move on to Zane, who's the MD of Flyt, and he'll give you more information about this opportunity. Thanks very much, and please contact me if you want more information on any of our offerings. And please note that this cannot be construed as advice. Please give me a call and we can discuss this further. Thanks very much.
Good morning, everybody. Thanks for joining us here today. My name is Zane Dedeker. I'm the Managing Director of Flyt Property Investment. Flyt is a Cape Town-based property developer and investment company, and we have teamed up with Anuva in a joint venture to offer the market some very interesting and popular 12J investments that are all property backed. So thanks for joining today, and allow me a few minutes to explain our few products and how they work to you. So first up, 12J, a lot of people say, but property doesn't qualify under 12J, and that's not actually true. Property per se is actually excluded as a qualifying investment. However, hospitality properties are specifically included. So in terms of the regulations and the 12J Act, Section 12J of the Income Tax Act, hospitality properties are included, and is one area that the government wants to promote, and that is due to the job creation directly by those properties themselves, as well as stimulating the hospitality and tourism sector, which is of course a big income generator for the country. So our focus is on investments that are in that category specifically, and those investments could either be pure hotels or service departments, or student accommodation also fits into that category. So those are the types of projects that we focus on. Typically they are serviced and furnished section of title units that we target under 2 million rand. So between 1 and 2 million rand unit value is where most of our projects lie. And we target a benchmark return of 11%, which is made up simply of a 6% income yield and a capital growth forecast of 5%, making 11% total return. Today's presentation won't focus too much on the specific properties that we have available. We're going to focus more on the structuring and how the investment itself works, the 12J investment. However, each of the 3 projects that you see here are available for investment at the moment and leading up to the February tax year end. Each investment, each project has information on our website or on the project's website. So there's quite a lot more information of each of these projects should you be interested in either of them. So please visit our website for that. But just briefly, Eaton Square, it's a new project completed earlier this year, located in Main Road, Southern Suburbs, Cape Town. Section of title mixed use scheme. Wink is a small apartment hotel in the foreshore of Cape Town. There's 30 units, all studio units servicing the corporate and tourism market. And Quivertree is a 100-unit block in Stellenbosch, servicing both corporate market and the student rental market. So 3 very interesting projects, all available to visit and have a look at, and all the information is online. So please do have a look at those after the presentation, and if there's any questions about that, I'll be happy to answer them at the end, and I'll focus on the 12J investment structure today. Within the Flyt offering, we've got effectively 3 products: the Flyt Select Fund, the Flyt Partnership Fund, and the Flyt Hospitality Fund. So if you're interested in property, you'll need to choose from one of these 3 options. and I'm going to run through each of them now. So the Flyt Select Fund, you would need to, here, the essence of the Flyt Select Fund is that you choose a particular unit at one of those projects that you will participate in. So you're effectively selecting your own unit that you are buying via the 12J structure. There is 95% funding available on that in that fund. In other words, you would just need to put down a 5% deposit, and then you use your tax refund plus taking a bond on the property itself to finance the 95% that you the 95% portion. After 5 years, you then take ownership of that particular investment out of the fund. The partnership option is similar to the select in that there's also 95% funding available, just a 5% deposit required. But here you don't need to arrange your own bond or funding. We as Flyt partner with the investors and provide the funding required. So in essence, you're effectively putting in your tax as cash flow, taking a loan from us for the balance. So it's a very easy way to come into the structure. And on the flip side, though, because we put all the funding in, we take a 50% share in that enterprise with the investors. So it's a 50-50 partnership with Flyt. We provide all the capital on loan to enable the tax deduction. And then the Flyt Hospitality Fund is our general fund. Here there's no funding available. In other words, if you want to invest here, you put all the cash in yourself, and that goes into a blended portfolio which participates in all the projects. So we're just building up a general balanced fund of units over time. So it's a fairly vanilla offering without the financing available. So I'm going to go into a bit of detail of each of them just to show you how they're working, how they work, and what the real benefits are. Just conceptually, this slide is intended to show how 12J and property really work well together, and why the returns are enhanced so significantly by coming in through our structure. So say for argument's sake, you're looking at a unit that is priced at 1.5 million. The investor would obviously put in 1.5 million to buy that unit. If you are in a 45% tax bracket, which is the highest, now each investor would obviously be different, but the maximum would be 45%, or possibly a bit less than that, depending on your own income profile. This example assumes 45%. So you invest 1.5 million, SARS will give you back 675,000 Rand, which means that your effective risk capital that you've put in is 825,000 Rand on that million. But because you are, in essence, buying a sectional title unit of 1.5 million, the model allows for you to raise a bank loan, a normal mortgage bond, on that unit itself. So this example, we've assumed that you go to the bank for, say, 750,000 Rand, which means that your own investment is right down to 75,000, which is the 5% deposit. So put differently, you can finance that 1.5 million Rands by putting down a 5% deposit, 75,000 Rand, using your tax money of 675,000 and a bank loan of 750,000. When you exit this investment one day, of course, the loan from the bank goes back to the bank, but that 675 that SARS put in, that becomes yours. That's after the 5-year period. I think Andrew mentioned there's a 5-year period. So if you exit the investment within 5 years, SARS would need a recoupment of that. So you effectively pay that back to SARS. If you hold it beyond 5 years, that money effectively vests with you, and there's no recoupment. And of course, the money you put in goes back to you. So there's a significant boost of return from that tax coming through, and of course, all the growth and the returns of the full 1.5 million also flow through to the investor. So just by way of comparison, if we're targeting 11% total return on the 1.5 million, you can see that significantly boosts up to, say, 22% on the 750, which is your net risk amount, or 220% on the actual cash that you put in, which is 75,000. So it really does enhance your IRR on cash tremendously. Just briefly, I'd like to run through the structure of the Select Fund. So what we have here is the typical structure. The investor would invest into the 12J company, that's Anuva, on the left-hand side. So the money, so the 1.5 million, for example, goes into the 12J company. what we would have done in the first instance, we've set up an SPV. So each investor gets their own sub-company or SPV within Anuva. We allocate the shares of that company, 1/3 to the investor directly, and 2/3 to the Anuva company, the 12J. And that allows the investor direct oversight and control of their own investment, which buys the property. So the SPV actually purchases the property. And then that's the holding pattern for 5 years. After 5 years, you have the option of exiting Anuva, but keeping your investment. So there's a mechanism built in where you can, in essence, sell your shares back to Anuva, your 12J shares, and at the same time buy the remaining shares, the 67% from Anuva of the SPV. So you'll end up owning that SPV outright, which still owns the property. So why that's quite attractive is that you don't pay any exit fees or any exit taxes. So you roll over your capital gains tax that you otherwise would have had to pay. So that's a very neat structure, and I can go into more detail on that in the Q&A section afterwards, but the tax saving on the exit is tremendous here. So you exit Anuva, you keep your property via the SPV, and at that point in time, of course, you're no longer subject to the 12J rules because you've exited 12J. So you can then actually be more flexible with what you use that company for. You can also sell the property out the company and keep the capital in the company and do other investments, for example, in there. So that's a very neat structure, and most of our investors quite like the setup of that, knowing that their capital is going specifically to a unit that they've chosen, and they'll have control of that via the SPV. This is it's a similar slide just to show the flow of funding and really how the funding mechanism works. A problem with 12J is that it's linked directly to the tax year end. So in order for an investor to get the tax deduction, they need to invest in cash in Anuva before February or by February. But the unit itself will transfer later because it's been purchased from a development company. It takes time to get to the deeds office, raise the bond funding, etc. So you actually need to put all the money into Anuva first, and then later you can take a bond on the property to effectively replace that money. So not everybody has the full value, for example, 1.5 million available upfront. So that's where our funding mechanism kicks into place, where you can borrow up to 95% of the value of your shares to buy the shares. So this slide just explains that and shows you how the funding works. So briefly, these are all the players. The first step would be to set up a new company specifically for you and for your investment. We allocate the shares of that company accordingly. Now, in this example, we're using 1.5 million again. So the investor here puts in 75,000 of their own money and then borrows the balance, the 1.425 million. We actually borrow that from Flyt. We have a lending company. And then the 1.5 million goes into Anuva. The 1.5 million from Anuva then gets used to capitalize the SPV. Now, because the investor made a 1.5 million rand 12J investment, SARS will give them a refund of 675,000, which the investor must then use to repay the original loan. So they will part repay. So they put that towards the original loan of 1.4 million. And then when the property transfers, at the bottom, property then transfers to that qualifying company, they would have raised the bank loan. So we pre-qualify the investor for those loans. And 750,000 Rand in that example comes into the qualifying company. The investor then uses that cash to fully repay the original loan to Flyt, which means that you've cleared the short-term loan. That loan was to enable you to borrow the money to buy your shares in Anuva. You've now repaid that loan using your tax and a loan on the property itself. That's then the holding pattern for 5 years. In the meantime, we obviously manage that property for you. We'll get to that in a moment. And all the income that unit generates is available to service that loan to the bank. After 5 years, you have the option of exiting Anuva, i.e., should you want to actually take that investment out, that's your option. You exit Anuva, taking the qualifying company, all of those shares, but the loan arrangement stays in place, which means that your final holding structure looks as follows, and you can then, obviously do whatever you like with that unit, hold it long term, or sell it at that point. Just very briefly, for the accountants amongst us, just to do a little recon of that. So in essence, if you're looking at a 1.5 million rand unit, you would put down 5%, 75,000, and we would you could obviously put down more, but we require at least 5%. Then you would be able to borrow 95% to purchase your shares. So now you've got 1.5 million worth of shares. SARS would pay you back 675,000 rand. We work with each investor to work out what that value is specifically for you. So if you aren't a 45% taxpayer, perhaps you're paying a bit less, or you're a company at 28%, we work that out for you up front, so we know what your refund will be, and therefore we know what home loan bond you need to apply for. So we work that up front. That's how you've paid for it. Then just an assumption on exit. So say, for example, the 5% capital appreciation holds true. That unit you've purchased for 1.5 million, you'll sell it for 1.9 million after 5 years. At that point in time, your loan in this example will be outstanding at 645,000 rand, and there will be some capital gains tax to be paid by the company on sale, which will be 82,000 rand. So if after 5 years you'll sell the property, repay the loan to the bank, pay some capital gains tax, and your net cash position is 1.185 million, less the original 75,000 that you put in, your net cash position is 1.1 million. So that's that would be the example, assuming a 6% yield and a 5% growth rate. Then just the yield. So we offer, the 6% is obviously calculated on the 1.5 million, but in essence you've got a tax break of 45%. So your net yield, your effective yield on your risk capital is boosted from 6% up to 10.9%. So that's quite attractive. Just flicking over quickly to the partnership fund. The partnership fund works very similarly to the select fund, except here the investors don't need to get their own bank loan. So you're still able to come in for a 95% loan to buy your shares. You put down your 5%, but then instead of you essentially getting your own home loan, we as Flyt put in that loan on your behalf, or arrange for that loan on behalf. There's no personal sureties on that. We lend the money straight to the SPV, or we arrange it with the bank with our own relationship with the banks. So, and for that we then take a 50% participation in the SPV itself. So the structure is very similar. After the 5 years, those investors also exit. We all exit as a group, so the resultant structure is that the investors would then own 50% of that SPV, which owns the property, and we as Flyt own 50%. The slight nuance here is that we actually aggregate a number of investors together and buy several units per tranche. So if you are looking in the select fund, you'll choose a particular unit at one of the projects. If you're looking at the partnership fund, we would have we would put a list together, so you'll see which units are available. And you want to upfront with which project you're going to be participating in, and you don't necessarily then need to invest the value of a unit. You can invest any value upwards of $1 million. So $1 million would be the minimum value of which your contribution in is 35%. So from a cash perspective, the minimum is effectively 350,000 rand that you would have to put in, which is of course covered by your tax, or depending on your own tax rate. So that's how the partnership fund works. We then purchase those units, own and manage them for 5 years, and then after 5 years we can exit. Briefly on the management and the rentals, a few other advantages with the 12J structure. So if you were to buy a unit personally and just rent it out as a normal residential unit, you're paying the VAT and there's no opportunity to claim the VAT. But however, because we're running effectively a commercial enterprise, we are able to claim the VAT, which we do. So included in that 1.5 million example is 15% of that. So what's included in the model is that we use that VAT reclaimed to actually furnish the units, and then cover any other operational setup costs, as well as offer a 6% rental guarantee. So there's cash upfront guaranteed from the developer to cover the first year's 6%, and you are getting the benefit of that VAT in terms of cash flow. And just on the renter pool side of things, what we do is each project has a separate ring-fenced rental pool setup that that administrates and manages those units in that particular project. So it's very transparent. Every investor has full access to those accounts and to the oversight of the actual management on the ground. And the renter pool then appoints, in this case, Winkelpath Hotels as the operating company to actually run the reservations, the property management, bookings, revenue management, and so forth. So just that's a brief synopsis of how the management works. Then we can certainly go into more detail on that should anybody want to. Yeah, and then so just in summary, the partnership, currently we've got Wink available under the partnership. We're busy working on another round because I think Wink is almost sold out. I think about 98% sold out in Wink. That's the units in town, in the CBD of Cape Town. And then we're busy working on the next tranche, which we'll probably release before the end of the month. And at the moment, the other two projects, the Eaton Square project and Quiver Tree project, those two are available on the Select project, Select Fund.